Stanford University.
So I'm really excited to introduce Miura-Ko today. She's a partner at Floodgate, where she focuses on investments in e-commerce, security, and big data. She started her venture capital career as an analyst at Charles River Ventures. Since then, she's been a board director at companies that you've heard of, like ModeCloth, Zimride, Lyft, TaskRabbit, companies like that. For the PhD students in the room, you may have seen her when she was doing her PhD here many years ago, for those of you
not so long ago, actually.
who've been around for a while. Or for those of you who haven't been around as long, you might have seen her as a lecturer in some classes at Stanford. Fun fact is that she has a passion for robots, so she was on a team that actually designed robots to actually play soccer. So really excited to have Anne with us here today.
Hi, thank you. So yeah, just to give quick background on myself, I guess it's a little bit about me. I went to high school far away at Pali, right across the street from Town and Country, which is much fancier now than it was before. Yep.
Were you classmates with Jeremy Lin?
No, he's much younger than me. But I love you for asking that, because that means you think I'm a lot younger than I am. I went on to get my BS in electrical engineering at Yale, and that's where I studied robotics. And it was sort of the first time I discovered a love of programming. Most of the time, like, my parents made me do it, and I didn't really love it. Even in our EE classes, we had to do it a lot. But when I first saw a robot move according to the algorithms that I programmed into it, I just was like, I thought it was really magical. After that, I worked at McKinsey for a few years. I also worked at Charles River Ventures, as was mentioned. My second day of work at Charles River Ventures was 9/11. And so to say that I actually participated in venture capital for the 2 years I was there is really an overstatement. I saw basically very little action, but I had the opportunity to analyze the venture capital industry with a partner that I really respected. And what we discovered was everything was really slowing down, but there was a lot of money that was still piled into venture capital. And the question was, what was going to happen? And back in 2001, we were saying, oh, it's going to all collapse in the next 3 to 5 years. Well, it took a lot longer than that. And so only in the last couple of years, I would say, have you started to see the impact of the capital overhang. And a lot of venture firms have had some trouble raising funds, and I would say that the general pool of venture capital is shrinking. After I completed my program at Charles River Ventures, there really wasn't a program. I was really trying to figure out what I was going to do with my life. And so Ted Dintersmith was just nice enough to sort of go along with that. The first year, I was actually applying to law school, so like Dave Hornick. Except my husband was in law school at the time. He was at Harvard Law. And I had been this debater in high school, and I really loved debate. I was pretty good at it. And I also was really good technically. So I said, well, obviously that means I'm destined to be a patent attorney. And so I would look at what my husband was reading, and some of the stuff I thought was fascinating, but like 90% of it I couldn't comprehend or wasn't willing to even put in the time. And so I thought that was a good indication that perhaps I should figure something else out. That's when I ran across a couple of PhD programs that I thought were really interesting. With that, I was imagining that as I emerged from a PhD program in something technical, I could start my own business. And so I thought coming back to Stanford was ideal for that. And then I was looking at programs in math modeling, and I combined that with computer security, primarily because I was saying to myself, if I come out of a PhD program, I don't know how long it's going to take. And so if I come out having done something in computer security, there's always a computer security problem. And so there's no timing issues there. So I ended up doing research in math modeling of computer security, really liked it, but really fell in love with teaching. And so had the opportunity to teach a bunch of classes in MS&E and STVP, really enjoyed that. Had a chance encounter with an angel investor, Mike Maples, who was doing some really interesting angel investing. And my old mentor, Ted Dintersmith, said, well, if you're going to go and start your own business, you should go and find an angel who's doing a lot of investing. You should see what kind of deals they're looking at and see how your ideas compare to the real world. And so I convinced Mike to let me sit in on his pitch sessions once a week. and would spend about 10 hours a week with him. And in that process, we got to know each other, really liked each other, and I think 6 or 7 weeks into that, he calls me as I'm driving up to Tahoe, and he says, I have this great idea. I think you should drop out of your PhD program, and even though this isn't a venture-backed startup, you could think of it as a backed venture startup. And he had just raised institutional financing for his venture firm. And he said, join me as, co-founding partner of this entity. We'll figure out culture. We'll get to reinvent and reimagine what venture capital looks like. And then just to put that in context, this is 2008. So it was right after Bear Stearns had completely collapsed and Lehman Brothers is on shaky ground. And so my mom is saying, let me get this straight. You're leaving a PhD program. You're starting a financial services company as all these banks around you are collapsing. Why is that a good idea? But Mike had this new idea, new notion of what venture capital would look like. He was saying 500,000 is the new 5 million. And at the same time, I'm seeing students around me be able to start companies for very little cash because we're seeing, they move beyond blade servers to cloud computing. And with $30, you could really get something started. And so to me, that was really interesting. So at that point, I convinced myself that this was something I really wanted to do, really liked Mike, and so kind of jumped in. I ended up completing the PhD on the side, ended up having my second child 6 months later. After I started Floodgate, or no, it was a year after I started Floodgate, I had our second child. So in the process of, within like a 6-week span, I was investing in a company, I had a baby, and I defended my PhD thesis, which was insanity. So what's happened since then? So these are some of the companies that I personally have invested in and have sat on the board of. Lyft, many of you may know, it's the company with the pink mustache. I'm going to talk a little bit more about them. ModCloth is an e-retailer. They have over $100 million in revenues now. They're located in San Francisco. They were one of the first investments that I made. TaskRabbit was the first investment that I made. It was the first board that I joined. I convinced Leah to move out from Boston and come to San Francisco and make a real go of it. Inscopix actually has roots in Stanford. It is a PhD student under Professor Abbas over in electrical engineering. He came to me with $1.5 million of pre-orders for a microscope that he had created. And in the process of the last 2 years, he's actually sold almost $7 million worth of these little microscopes, which literally can read the mind of a live mouse. And you can stick it into the USB port of your computer, and you have like a live mouse whose brain you're reading. He's trying to turn that into a neuroscience company. But what's really impressive about him is I gave him about $1 million, and he has yet to touch the $1 million, and yet has generated $7 million in revenues. Very impressive company. Refinery 29, for anyone who's sort of fashion-bound, is one of the largest lifestyle and fashion online magazines. And they've dabbled in some commerce, but they're a real influencer in the market. They have over $30 million in revenues. And Wanilo is a mobile app that has over 11 million registered users. You could think of it as Twitter for products. So you follow people, you follow brands, you follow stores, and you get a feed of products that come in into your mobile app. It's been incredibly popular, as you can imagine, with women, because we love to shop. And the last one I would say is Ayasti. This was also a Stanford company. I found Gurjeet when he was still a postdoc, and I'll tell you a little bit more about that. But he was a really interesting postdoc math student. Chased him to a classroom at Stanford and basically put him in a headlock and made him take a check from me. So the thing that we often talk about Floodgate, we talk about hunting thunder lizards, and half the time I roll my eyes when I'm talking about this, half the time I really embrace it. This really came from my partner, Mike Maples, and he really loves talking about thunder lizards. So thunder lizards is a metaphor for the top 10 to 15 exits that we see in any given year. And throughout time, what we've seen is, and I've done this study back to 2008, I think, and we're looking at all of the exits that were over $50 million. And there are always about 80 of them. Yep.
Do you feel the unicorns captures it, or is it Thunder Lizards that best captures this phenomenon?
It's really funny. So Mike has been talking about Thunder Lizards for a really long time, right? Dave knows Mike really well. So he's been talking about it for about 10 years. And before he was even in the venture industry. And so when Aileen came out with her analysis, we've done similar analysis but kept it sort of in-house for a long time. And we share an office. He comes in and I said, hey, have you seen this analysis? It's really interesting. Aileen Lee's done it. We have a lot of similar insights, but there are a few things that she's added. And he looks at me and he goes, can you believe she called them unicorns? And I was like, well, unicorns, he's like, Anne, unicorns aren't even real. I'm like, and thunder lizards are. So for him, thunder lizards are born from radioactive atomic eggs. So that's sort of, the nuclei of the entrepreneur, the DNA of the entrepreneur is fundamentally different. They swim across the Pacific Ocean, emerge in Tokyo Harbor with an attitude, and then proceed to destroy the city. And this is where, I'm Japanese, so I get mortally offended by this because he thinks that's awesome, and I'm kind of mortified by the whole thing. But he says, you eat trains, you're sort of disrupting things. He has this picture of a Godzilla eating like a building. And so this is something that we think about a lot. In fact, we're going to go see the Godzilla movie when it comes out. We actually, each of us, instead of having Floodgate hoodies, have dino onesies. And we've even sent a couple to our limited partners. And one limited partner actually said that if we ever have a return the fund exit, that she would wear it to her office. This is Elizabeth. And so it's really skewed my view of like what to do about some of my exits. If there's even a chance of it being return the fund, I've actually thought about just selling it all just to see her in the suit. But returning to this concept, we think about it from 4 different areas. So one is the authentic entrepreneur, and you'll see this in a couple of examples that I provide. We aren't thinking about serial entrepreneurs. We really look for people who are truly authentic to that idea. So when you go through the ups and downs and near-death experiences of an entrepreneur, you really want someone who's going to stick by that idea. And the best ideas actually have some of the worst near-death experiences. And so when we look at our founders, we don't want to find someone who has written a really great academic business plan that really makes sense. What we want is someone for whom this is the idea that they have to bring into existence. And it's something that's a living, breathing part of them. And that happens for a lot of different reasons. But the quintessential example for me was when I was observing a bunch of pitches in the fashion space. And this happened to be a day that, for some reason, we had about 3 lined up in the fashion space. And it was the day that ModCloth pitched us. 2 of the teams actually had only engineers. They were all male. None of them had ever looked at a fashion magazine. When I asked them about Elle or Vogue, they kind of gave me a blank stare. And they just felt like the iPhone was just this great experience by which you could see beautiful photos, and obviously fashion had beautiful photos, and so this was a great opportunity for them. So it was much more technology driven rather than idea or market driven. And so in walks Susan Koger, the last pitch, and she's been vintage clothing shopping since she was 13 with her grandmother. And she ended up accumulating all these clothes and started selling them because it was filling up her closet. And she got her boyfriend to create a website through which she could do that. And that was the initial genesis of ModCloth. So we really are attracted to the narrative of why you came up with that idea. The second is undeniably it has to be a large market, right? If you're going after a very small surface area, it's very difficult to have a really great strategy there. It's hard to get lucky. And so what we're looking for is a large enough market that if you get lucky, you can have $1 billion opportunity. The third is that you are unconsensus but right, and this is something that Andy Ratcliffe oftentimes talks about, and I think it's so insightful, right? If you have a consensus market, it's someplace where everyone's headed towards, everyone agrees that there's a huge opportunity. You're just going to face a lot of competition. And so you want to head towards a place where it's unconsensus. It's an insight that you uniquely have. But then, of course, you have to be right, right? So if you're wrong, it doesn't really matter if you're unconsensus or consensus. So we look at whether or not you're unconsensus and right. And lastly, because we're a relatively small fund, we're looking for businesses that can be capital efficient. So if you're going to have to raise hundreds of millions of dollars to get to any kind of traction, it's very difficult for us to make a lot of money because we're just going to get diluted just the way the founders were. And right now, we feel like uniquely there's a lot of opportunities for building capital efficient businesses just because of the commoditized hardware, open source software, all the different opportunities you have for building websites or even testing businesses without having to put a lot of capital at risk. So who are we? We're a $75 million fund. We are now on our fourth fund. We've had 2 funds in a row that were $75 million. We kind of like that number. We feel like it's good for the two of us. We do primarily Series Seed and Series A investments. We tend to be the lead investor. Exceptions have been made, especially if Dave Hornick is in the deal. Board seats on about 50% of the investments, so we're fairly involved with our companies. And our check sizes range from $500,000 to about $3 million. So we've written some of the larger checks for a microfund, but we also do serve our core investments in the $500,000 range. Any questions there? Yep.
Other speakers have come and spoken about how there's been micro-VCs like you all, and then there's micro-VCs.
Yeah.
Can you elaborate on that? And do you think that there are check sizes that are smaller than yours that are still make a significant impact?
You know, I honestly think that the question of capital is pretty, it's commoditized, right? And so whether or not you're a micro fund or a micro fund or a super angel or an angel, I don't think that really matters anymore. As entrepreneurship is much more democratized, it's not just about the check size that you bring, but it's sort of what's in your portfolio, what do you know that maybe the entrepreneur doesn't know because you've had a set of experiences growing these businesses. I think that it's about the quality of your partnership. It's the what kind of work you do together with your partner. So I think that's more what I would be concerned with, because there are people who write $50,000 checks that bring enormous amounts of value, and there are people who write $500,000 to $10 million checks who bring negative value, right? And Mike and I often joke that if you go to a board meeting and you're entirely silent, then you're automatically in the top 25 percentile. So I would say that's what's more important. You know, there's so much value detraction that happens by distracting people or asking detailed questions about the wrong thing and not having an overall view of the strategy of the business. That can be harmful to a business. And so I think that's the thing that as an entrepreneur you should care most about is how do these people actually help you, and how much do they trust you to make the right decisions as well. So I think that trusted relationship is very important too. Yeah.
How much time do you spend on companies that you financed?
It's probably, for me, about 50%, maybe a little bit greater than that, 60%.
Is it all board meetings, or what do you do?
It's not. So I would say about a third of that is helping to hire. And so especially at the early stage, it's just convincing people to come on board before there's any proof points for why they should, right? I think that, right before this class, I was on a 30-minute call with a portfolio company that just had a few questions, and they wanted to run a few things by me. A lot of it is sort of these ad hoc requests. Do you know someone at this company? We're about to launch this product. We want to go out with lighthouse customers. Here's a list of the companies. Can you make connections to them? I also am spending a lot of my time now building out business development relationships. So at the larger companies who can help our portfolio companies in different relationships. We spend a lot of time cultivating those relationships too. That stands sort of as part of our portfolio work, but it's also just sort of generally helpful for us. Anything else? So one other thing that I thought I'd give you is a little bit of a taste for how we're thinking about building businesses. And so this is what we call the value stack. And so these are the problems that we oftentimes talk about, how you solve these problems. And it depends on where you're seeing the business. So most consumer internet companies start at the product level of the value stack and make their way up. But if you're a PhD student at Stanford and you really have just a couple of papers that you've written and you have a real technical insight, then you're starting at the bottom, which is sort of the technology element of the value stack. And to make your way up from a technology to a product, you're oftentimes trying to solve for this technology in search of a problem or a market. And you'll hear this a lot if you're taking some of these entrepreneurship courses and then you have a bunch of PhDs in the room. They have this really interesting widget. And it's very high tech, it's crazy algorithm, but no one knows how they would actually use it or apply it. And so they spend the entire class running around looking for customers who might be interested in it. And the question is there even a problem to be solved using that technology? So we work a lot with companies at this level as well. And so I'm working with a few PhD students already. They think they have for ad optimization technology. Is it really that important to be, 10x better than the existing platforms? We don't know. A lot of the incubators will have companies that are at the product stage. Right? So Y Combinator is a great example of that. They'll have companies that have built out some interesting product, and now they're going to test it for the next 10 weeks to see if they can have some interesting traction before demo day. And here, a lot of times, we're looking at whether or not there's a feature and not just is there just a feature within a larger product set or set of products that a company should offer, or is this a standalone product that you can build a company around? So that's something that we often think about. And then company to market, this is where a company is developed and now they're really trying to think about how they dominate a market. And oftentimes here we'll see businesses that have traction, but it's not really a business, right? And it can happen for a lot of reasons. So it could be that the basis of culture for that company was not set in the right ways. It could be that the fundamentals of the business were kind of shaky, and no one really believed that this company would be around 10 years down the line, right? And we've seen some companies like this in the past, and some of them will even go public, but after a few months, they just kind of start to fizzle out. And so as we think about our companies progressing up this value stack, those are the things that we're always worried about, and those are the things that we're trying to help our businesses with. So I thought I'd give you 2 vignettes on companies that I've worked with, just to give you a sense of like how long this stuff takes and what it looks like when I'm looking at it. So the first one is Zimride, which is now since turned to Lyft. So I led the seed financing in 2010. They pivoted in late 2012. So it took 2 years for them to get to the point where they had Lyft. In between then, we had one round of financing led by Mayfield. And that round of financing, let me tell you, was really, really hard to get. We went up and down Sand Hill Road trying to convince folks to invest in Zimride. And John and Logan were really special entrepreneurs. They actually came together around the idea of innovating on transportation. Now, at this point in time, you might all think, of course, you should make an investment in transportation. But back in 2010, when I made this investment, the only comp we had was Zipcar. There was not a single investment out there in the venture world where they had made an investment in a transportation space except for Zipcar. And so I spoke to actually Scott Griffiths as we're looking at this business. And it was an interesting business. Some of you at Stanford may have used the Zimride platform to find carpooling. But it was this platform because they had this vision from the get-go that they wanted to innovate on transportation. And John Logan actually was the one who started the business. He was so interested in transportation that when he was in Santa Barbara for college, he actually joined the county transportation board because he felt like there was a huge opportunity there. Simultaneously, he met John over Facebook because they were friends of friends. And John had taken a class at Cornell where a professor had said that he believed that in the next generation there would be at least one, maybe multiple huge transportation startups because that was an area that had stagnated for so long. And for some reason that really resonated with John, and when he saw Logan was working on this thing called Zimride, he immediately connected up with Logan. They started this business. Now, even when I found them, and I'd spoken to a prior co-founder who actually left the business before I invested, they had apparently gone around to a lot of the seed investors looking for financing and were not successful at it. And so as a result, one of the co-founders left. There was a point in time where I know Logan had said he was going to eat from one can of beans, and he'd bought this huge can of beans for the next 2 weeks because that's the way he was going to save money. I think it lasted like 2 days. But that was sort of the moment where I found them, and I loved them because they were authentic. There was some traction that they had. They had covered most of the UCs. They were in Stanford. They were into a lot of these universities, so I felt like there was something there. But not really proven. Who knows how big that market is? Now, from their perspective, they're looking at me as an investor, right? So in 2010, I am still completing my PhD, so I'm a PhD candidate. I've made one investment so far. I really don't have any kind of reputation, right? So I'm a new investor. I don't have a track record. Even Floodgate itself is pretty much a no-name. So the story is really that as much as I was placing a bet on them, they were placing a really big bet on their venture investor. And to reflect that, I mean, I didn't really have space at the time either. And so it's not like we had a big fancy conference room to go to when we had board meetings. We literally would sneak into the common rooms at the law school dorms here at Stanford and have our board meetings there. And so to think about just the genesis of Zimride and how scrappy we were both at that stage is something that I really treasure. So Zimride then goes on to raise their Series A. It was a difficult Series A to raise, but Mayfield really believes in them. Raj Kapoor was just an awesome board member. He was just there on the ground all the time trying to help out. And one day they come into a board meeting, they say, we really feel like we need to go mobile first. And we've hit upon a design that we think is interesting. And at first they said, we're thinking of doing a community-driven approach. And so we'll have peer-to-peer driving. So someone will be driving, they'll be background checked, but you could basically call upon them to come to you. But we think that in order to give this like a really unique bet, we want it to be a female-only network. And so they were going to have only women drivers and women riders. And I remember thinking to myself, that was really interesting. And then afterwards, I'm like, that really cuts our market quite significantly. And they said, just even a week later, they're like, we just dropped that idea entirely. Women are gone, gender neutral. But we have this great mustache thing we're going to do. And when
genius.
I was like, that's amazing. So then they launched this thing, and I wasn't in San Francisco for that week, but one of our associates was, and he comes into the office on Friday, and he said, "Ann, this thing is going to be huge. I took 6 lifts just yesterday. It's amazing." And man, if people have talked to you about product market fit in a theoretical way, you don't know what it is until it hits you in the face. I mean, that is product market fit. There was so much demand for this product, and it just kind of shot through the roof. Really exciting period for them. The untold part, though, I thought was interesting was they had to shut down Zimride, right? So if you think about it, they have limited resources, and this thing is taking off like a rocket ship. I think it took a lot of courage because these guys, they didn't know where this thing was going. They just had a couple of weeks of data, and they're starting to think, like, if we don't really devote our resources to this, we're going to get killed by competition. And I remember taking a long walk with Logan where he's saying, you know, how do I think about what do I tell my team? How do I devote resources to this? And I know everyone around them was saying, this is it. You got to go for it. But for them, it couldn't have been easy, right? You think about Logan eating from a can of beans supposedly for 2 weeks to keep this original idea alive. There's a lot of emotional commitment to what they had been originally doing. And there was a lot of sacrifice. Like, I don't even know all the sacrifices they made in order to make Zimride a possibility. But to really, like, essentially shut it down to some extent and devote themselves to Lyft took a lot of courage, but they decided to do that, and they went whole hog into it. And it's proven to be really great for them. So that's a ride that I will always remember. Okay. The next one is a Yasti. So this one also, I led the seed financing in 2010. So when I met Gurjeet, he had no business plan. He had 4 math papers that were sent to me. And lucky for me, I was trying to finish up my PhD. So every morning I was waking up at 4:30 in the morning, and I had a stack of papers I needed to go through. And so I just happened to put his papers up top. I read through them, and I said, there's something here. We continued to meet for a little while. He didn't really know which verticals he was going to go after. This was a big data platform to do analysis of very complex data. And I thought it was killer technology. And so ultimately, I got so enamored with it that one day I left my office and I drove down to Stanford, and I knew that Gurjeet was taking this one class. And so I stood outside the class, and I had this checkbook in my hand, and I wasn't even sure, like, if I had signing authority on the checks. But I wrote a Yasti, and I signed my name. I wrote $1 million. And I sat outside his classroom, and he was like, he comes walking out. I said, Gurjeet, I have to talk to you about something. And he's like, what's going on? I said, I have this great idea. I think you should raise $1 million from me right now, and I have a check for you with your name on it, and we could get started. And he was like, hold your horses. I don't even know what I'd do with $1 million. I've never even asked you for $1 million. So he had at least enough business sense to be like, let's slow down this process a little bit and think about why I'd be raising the money. It took another few months to convince him to take money, but ultimately he started to have some customer traction. And so he said, I think it's time for me to raise some seed financing. I'd like you for you to be the lead. And so I led that financing. It took another year to convince Series A to come in. Again, there we went up and down Sand Hill Road. A lot of doors slammed in our faces. A lot of people actually saying Gurjeet wasn't the right CEO at the time. But Vinod Khosla ended up believing and wrote a $10 million check. Following that, they really started to hire the right management team. We started to have some proof points with companies like Citibank and GE, and then IVP led a $30 million round. And since then, you know, they're just continuing to crush it. And so Gunnar was the chairman of the math department here at Stanford. And these are 2 of his PhD students who are all part of Ayasti. Gurjeet is still the CEO, has proven to be a very scalable CEO. But again, it's a very different company from Lyft, but also one that I'm particularly proud of because I feel like it shows a very different side of me as an investor, but also because I feel like I really saw it before anyone else did. Yeah.
As a quick aside, is this the company that tested its product against like a Stanford Medical School database and like solved the problem they hadn't solved?
Yeah, so they did it for a breast cancer tumor data, and they actually found insights in that data that it had taken them, I believe, 1.5 years to discover in the medical school, whereas it took someone at IOSTI who didn't even know what the data represented, I think, a few hours to discover. So it's really interesting. Yeah.
2 weeks there last spring break. This is the company that did the whole basketball positions analysis,
Right.
and discovered that there are like 13 positions as opposed to 5.
Yeah, so that was actually an undergrad who's a summer intern. A student of mine actually came to IOSTI, and he did this athletics analysis. And what was great about that was, as a result of it, he ended up being like number 2 in 30 under 30 for Forbes magazine in athletes, in sports, I think. Like underneath, I don't know sports that well, but like some big basketball star. And so it was really interesting to just see, like, I've told other students, if you really want to be in Forbes 30 under 30 in sports, but you don't have quite the athletic chops, you should do a summer internship at one of my portfolio companies. But yeah, it's been really great to see them. Yeah. And then I think that's it. I think, and then we have our case study. So before that, do you guys have any other additional questions? Yeah.
I'm just curious, what trends or what like industries do you think are pretty stagnant now that like you're interested in, just out of curiosity?
I think actually a couple things. I believe that mobile is changing everything, particularly in the enterprise. And so the same way a lot of applications, as they went into an online format, really changed from client server to online, I think that we're going to see a massive shift in terms of players when it comes to enterprise software moving from just online to mobile. And we're seeing really interesting mobile-first enterprise companies. On the consumer side, I think that another area that I'm still interested in is the big data space within the enterprise. I think that companies that are able to capture a lot of information and then understand it will have really great ways of impacting businesses. And the whole question is how that information is captured. I think SaaS is one way of doing it, gathering all that information, then pushing back out analytics to companies. But there are other ways of doing it, pure play analytics, big data software is another. On the consumer side, I'm seeing a lot of marketplace businesses these days, and that's an area that I continue to be interested in. I think the sharing economy has really unleashed a lot of different models within the marketplace segment, and so that's an area that we're spending a lot of time.
I asked this of everyone because it's my passion, but what are your thoughts on the emerging space economy? Folks like Planet Labs, Skybox, and SpaceX.
Yeah, I think they're very interesting. So I actually saw Skybox when it was in one of the classes. And I remember coming back and seeing Mike and saying, there's a really interesting company. It's the best one I've seen out of any of these classes. And he said, well, is it capital efficient? And I said, probably not. You have to launch things into space. I think they're really interesting. I think that there's a lot of competition now in this space, interestingly enough. Like, it was not something that I would have expected. SpaceX, I think, is different than those because they almost have a talent monopoly, which is really interesting. It used to be that if you were a rocket scientist, right, you would probably go work for the government, or there are a few other companies you could work for. Right now, every awesome rocket scientist probably wants to work for SpaceX. So anytime you can get a monopoly on something, particularly a resource like that, I think something really magical happens, and that's what I think is really interesting about what SpaceX has accomplished.
Hi, many have described you as being very technical as a venture capitalist, and my question is how do you think being very technical helped you in your making investment decisions?
I think it helps when I'm not in the consumer side, because I don't think there's that much differentiation on the technical side. I think it helps me on things like IOSTI, or when I'm looking at a company like Inscopics. I'm just able to evaluate it. I'm not afraid to open up a bunch of papers and read them. And so from that perspective, I think I also have just the curiosity to keep up on that front. But there's different kinds of technical, right? I think I'm very mathematically technical. I haven't worked with a Hadoop cluster, so there's different kinds of technical capabilities that people can have, and I have one flavoring of them. Yeah.
So you talked a little bit about starting a company based on a technology versus a product.
Yeah.
Do you have differing expectations as an investor for a company that's starting in those different segments?
For sure, that's a great question. So when we're looking at a company that has a technical insight and we believe that it's, weapons grade plutonium, then that's what we're really evaluating. We're trying to figure out how important is that technology and what can you do with it. And the presumption is if you can productize that technology and the market is there to accept it, then there's a huge market and we will have some sort of protection, right? It's very defensible because there's fundamental technology there. For product-oriented company, what we tend to look at is traction. And even as an early stage investor, one of the things that I find really interesting is that because we don't make that many investments in any given year, so we're not a micro fund that makes 100 investments in a year. We're probably selecting somewhere around, between the two of us, 8 to 10 companies to invest in, which means in any given quarter, we're investing in about 2, maybe 3 companies, right? So if you think about the ones that actually float to the top, especially if you have a product out in market, the ones that are really going to be noticed are the ones that have some interesting numbers associated with it. And so I would say if you're a product-oriented company, we're really looking for how the market is reacting to that product.
So going back to when you were starting your VC adventure and stuff, you kind of looked at multiple different sectors and just kind of all over the place in terms of like big data, and you talked about big data, transportation, and stuff like that. Did you, when you were starting off, did you have some sort of a thing where you wanted to see, okay, we're going to do VC, but we want to focus on certain areas, maybe security or something, since you already had domain expertise in that, versus we're just looking for like really great entrepreneurs or authentic entrepreneurs, as you put it?
There were a few areas I was looking. I actually did look quite a bit in security and made one investment, and ultimately got sold to Twitter. I looked also a lot at e-commerce at the time. So in 2008, there weren't that many investments being made in e-commerce. And there are a few hypotheses that I had that I wanted to test out. One was community-oriented commerce. Another one was what's the next generation QVC, and a couple of different ideas. What's the next generation multi-level marketing? Does it look like Avon or does it look like something different? So I had a few areas where I was chasing companies, and then others where I was more passive about it. The sharing economy I really stumbled into. I met Leah, just kind of fell in love with it. It just happened to be really one of the first businesses in that area. We had also seen Airbnb and turned it down, if you can imagine. They were actually selling cereal boxes at the time to fund their business. And they were selling Obama O's and McCain somethings, and they were going to go to the Democratic convention in Colorado, and it was before they really blew up at that time. And so I remember Mike and I having this discussion around whether or not Craigslist killers will emerge around Airbnb, and we got totally scared off by the notion. But then we found sort of TaskRabbit. TaskRabbit was also very interesting to us. And after I made that investment, I also found Zimride through similar networks, and sort of got embedded in that kind of sharing economy type of business. But I think that it's just sort of some of the themes I've lucked into, other themes I've been more proactive about. I think IOSTI and data analytics was an area that I was hunting for. And so when I saw it, I knew that that was a company I wanted to be a part of. So it's a combination. Behind.
I'm just curious, can you tell a little bit more about how you were able to raise the first fund? I mean, it seems pretty interesting that you didn't come traditionally from like the VC background, right?
Right, so I didn't actually raise that first fund. So what happened was, as I mentioned, Mike came to me having raised the fund. And so to be totally honest, Mike was taking a really kind of a ridiculous bet because he had a really interesting track record. He had invested in Odeo that turned into Twitter. Dig at the time was also a really great company. It was exploding at the time. He'd invested in Chegg that was also doing really well. And so he had this incredible track record. He invested in Weebly and Demandforce, all these businesses at incredible low valuation. That fund is probably going to be a 10x fund. Based on that track record, he was able to raise a $33 million fund. Now, one of the things that the investors had asked him was whether or not he really wanted to build a firm or if he wanted to be a one-man show. And he had said that he wanted to be a firm. And so he was actively looking for a partner. But to be honest, if I were in Mike's shoes, I'm not sure I would have hired someone like me. Because it's hard to know like what kind of investments I would have made. It's really hard to justify sort of my background. And I look at myself from his eyes, and I'm kind of astounded that he took such a big bet, especially given that if things hadn't worked out, it would have looked really bad for him in front of the limited partners. That the first person he hired didn't work out. So it was a really big bet on his part, and he took a chance on someone who was totally unproven. So.
But in all fairness, I mean, this is in fact the problem that all venture firms have, right?
Yeah.
Hiring anyone in the venture business is a near impossibility, right? So, and so as we sit looking at people, and I look at my path to the venture business, it's interesting. Ultimately, since what we do as investors is bet on people,
right?
Theoretically, it's like, oh well, this is just a 10 bets in one bet, right? I'm going to bet on you, and then you're going to make 10 investments before I know if you're a complete idiot. We'll hope for the best, right? And seriously, like that was my partners. Oh yeah, lawyers suck at this. You'll probably fail, but welcome. Let's see how it goes. And I do think that I give Mike a ton of credit for it, because at the end of the day, it's very hard to be an individual, and that feedback loop's incredibly important, and you need to make choices, right? I find most venture firms are paralyzed by the inability to bring someone in. So obviously it worked out incredibly well for him, and it was risky for sure, but we just need, in the end, good investors simply have to invest, right? So.
Yeah, and I think that's the thing that was really striking to me was, I had this background from Charles River Ventures, but being an associate or an analyst at a firm where you don't actually have to make a call to that first moment where Mike's like, all right, Ann, is that a check you want to write? And then you're like, well, I don't know. Maybe not. Maybe yes. What do you think? I mean, it's terrible, but it's really having that decision-making authority changes everything.
Were you personally invested in the fund, though?
Yeah, every GP has to invest. So, I mean, there was a period where, honestly, the economics for a young GP can be such that my husband was like, I think your whole grad student make $26,000 a year thing was way better than what we're doing right now. Because I was like writing checks back into the fund, and we were literally paying for me to work. But it's...
Wait, sorry, I missed it. So when you originally, right after your PhD, you put money in. So
You invest into the fund too,
invest
because
in the fund, right?
the limited partners want you to be aligned with them, and the way to align
Yes.
theoretically is that I'm essentially cutting a check every time they cut a check.
So the law requires that you put in 1% of the fund as that the general partners put in a minimum of 1% of the fund, and the limited partners put in 99%. Now, in many instances, particularly in cases where it's early and new fund or whatever, then the way that general partners demonstrate that they believe in themselves is by putting in a disproportionate amount of money. So oftentimes that amount is 10% or 20% or,
It wasn't that high for us, but it still hurt a
but
lot.
but when you right, but when you do the math, I mean,
Yeah.
it can be very hard. I had my first general partnership. You have that realization, like, wait a second.
And your spouse is like, what is this? So it's an interesting dynamic.
It's an okay deal because if it's 1 to 99, right, then you're highly leveraged, right? So you should, on average, you should
That's if you have the one.
Yeah, and it depends on how big that fund is too, right?
1% of $100 million is $1 million. 1%
Right.
of $1 billion fund.
Right, but your first fund was 33 million, right? So it was
Sure.
300K.
That's if it was 1%.
It was 1%, right? Yeah. How
But
do you-
even then, so my husband's coming out of law school. We're still paying off his debt. I've been making like $26,000 a year at grad school. Stanford's so generous. And then I have 2 kids. And so,
Going to debt.
I mean, we were just, paycheck to paycheck. No, we didn't have to borrow at the end of the day, but it was really, it was pretty risky. But I was like, hey, hon, you're investing in me. Would you rather invest in the markets or would you rather invest in me?
I just have a question on the mentality behind that $75 million number. How often are you tempted to say, well, why don't we just, if we can ratchet this up, then we can keep a larger piece or get a larger piece of Lyft or Ayazdi, and when these companies start growing?
I don't think that's as much the pull. I mean, there is some of that, but I feel like if we really wanted to do that, we could go back to our limited partners and say, can we do a special fund where we cut another $10 million into this? Probably can do that. I think that the discipline around a $75 million fund has been that we want to imagine that our investments can return the fund. Like one single investment can return the fund. And how many of these investments do we have in our portfolio where we can imagine that happening? And as the numbers get bigger, it just becomes scarier for us. Now, the reason why a lot of investors get pulled in the direction of raising a larger fund is that you get management fees off of it, right? And so even when we raised a $75 million fund, we probably had demand for $500 million. But the thought of how do you return $500 million and how we would spend it just scares me. And so we keep coming back to the notion of, well, do we like what we're doing and do we like the business that we're in? We do. And then can we still imagine returning a $75 million fund fairly well? And I can. It's very line of sight for us. Now, if we add additional partners, we would probably need to increase that fund size. But until we do, we want to maintain the discipline of not being pulled by management fees or pulled by limited partners who want to put money in us, but rather strategically, what are we doing, being thoughtful about it.
Just to get a better sense of, organizational, just how many limited partners does firm usually have?
I don't think there's really a usual number. Okay. For us, we don't have that many. Okay. We have like 8 limited partners.
So, this is an interesting and tricky question that VCs have to answer, right? Having 8 limited partners is both awesome because you go to raise the next fund, you talk to 8 people. You want to make a decision, you need to make a capital call, you talk to 8 people. But two of your investors decide not to invest in the next fund, then you've lost a quarter of your backing.
Yeah.
So VCs often are very focused on how do you maintain enough diversity in your investor base and avoid massive concentration. On the other hand, massive concentration is awesome as long as they always exist, right? And so I think what you'll find is that as a general matter, there are a set of investors who could put in maybe $50 million into a typical Series A kind of fund like my own. You have those investors, they just put in the commensurate smaller version, right, of 5 million instead of, or 10 million instead of 50. But you don't want too many of those because again, if you have 10 investors in a $500 million fund, it's a lot of concentration. Right. So VCs are always sort of balancing it. There was a famous instance where a fund decided they were sick of institutional investors, and in the late 90s, all the entrepreneurs were really rich, and so they decided they'd just take money from entrepreneurs because they could add value, et cetera, kicked out all the institutions, and all the entrepreneurs then ran out of money. And it was a very, very bad choice. Turns out it was a perfectly lovely firm, and they had no problem finding alternatives, but that's a bad idea as well. And then we had a similar problem where in the 2008 timeframe, what happened was the economy crashed. Investors had largely relied on things like foundations, which were really good, steady investors. But what happened was the foundations were trying to keep only a certain percentage of their funds in what they call alternative investments like venture. So they say, okay, we have 10% of our fund in venture, 90% in these other things that are sort of marked to market. The market dropped by 50%, and suddenly their 10% was 20%. And VC doesn't get readjusted in the same way, and so suddenly those investors had no money to invest. So then everybody said, great, and went to fund of funds, which actually had money at the time. And I can tell you that 4 years later, when people went to raise money from those fund of funds, they didn't have investors. So it's this very tricky balancing act where you're trying to make sure that that you have an investor base that's going to have money, be enthusiastic, et cetera.
Sorry. My question is in regards to crowdfunding and what you think of crowdfunding as like a potential competitor to like seed investing, as well as what do you think of like crowdfunding startups like WeFunder, Kickstarter, Lending Club, stuff like that?
So I don't see it as a competitor at all. I mean, what I've seen is it's a great incubator, right? It's sort of saying, is Y Combinator a competitor or not? We see it as a great place where ideas get tested quickly and you see whether or not they take off or not. And so especially with places like Kickstarter, we're seeing that for hardware companies where it used to be so hard to test the market, now we're suddenly seeing that just by putting an idea out there with a video, people get a flavor for what it is, and you can get a sense of how exciting people think the idea is. And so you're getting earlier data points on these markets that we otherwise wouldn't have. And so from my perspective, it's kind of a really nice win-win. The question, I think, as an investing platform is whether or not it will be a good investment for the people who put money into these crowdfunding sites, right? And I don't know if we know the answer to that. If you're expecting venture scale returns, my expectation is that the individual investors into these platforms will not see that.
Sorry. When do you decide to sell, and how do you decide that, and what's that process like?
Sell a company?
Sell your shares.
My shares in a company. So we're venture investors, and so for the most part, we're in it for the long haul. Because we're seed investors, there are sometimes opportunities to get out. But for the most part, I would say we're kind of emotional investors, so we get bought into the company. I think it's harder to convince us to get out of it than it is to convince us to, stay in. So I would, I think the process has usually been where we've ended up selling shares is another investor comes in and they can't get quite the ownership that they want. Either because the company doesn't want to take additional dilution, the founders aren't willing to sell. And so I've seen situations where all of the seed investors are asked to sell a portion back to that investor. And we'll play ball in that situation for sure.
I guess the mic. Oh, you can go if you want.
Okay, thanks. So as a follow-up to that, how soon do your institutional investors want their money back?
They have a really long time frame. I mean, they look at us like a venture firm, which the time frame is 10 years plus.
Okay. And on another note, we recently learned about how Andreessen is putting a lot of effort into adding value to their investments with manpower. Is that kind of equivalent to what the general partners in a seed fund would be doing?
So I think there's a lot of different ways of cutting the way VCs approaching this, right? So I think there are the VCs where they want to put a lot of people against the problem. The polar opposite you'll see even within the larger venture firms and in the smaller ones as well, where people don't want to outsource it. And it's just sort of philosophical difference. Some people have created platforms to enable communication amongst a lot of the CEOs. We've taken sort of more of the approach that Mike or I are responsible ultimately for the company. And so if the company needs to hire someone, we're not going to pass it off to someone else. That there's a function of the fact that we're a small fund, right? And so we don't have the resources to put millions of dollars into marketing, right? But at the same time, for us, especially at the stage that the companies are at that we work with, they don't need the kind of resources that we're talking about from like the Andreessen Horowitzes of the world.
Last question.
Sorry. Yeah. So my question, I'm just curious to hear more about what your thoughts on the sharing economy is. Like, is it, there's a debate where there's a winner-take-all market, and it seems like that's going to be that way. But I'd just love to hear what you think about it since you studied it.
I don't think it is a winner-take-all market. I mean, we've even seen within San Francisco that if that were the case, then you would see Uber completely dominating, and yet Lyft has a significant share of the ride-sharing economy there, and if anything, they're growing faster than Uber on the lower end. So I think that's why it's so fiercely competitive, that there's a belief that there's sort of the economies of scale is important, and yet what we've also found is branding is quite important, community is quite important. And so marketplaces require scale. It doesn't necessarily mean it is a winner-take-all. And so I think that's the tension that we're seeing. That said, what I think is interesting is that these vertical plays are doing really, really well, right? Whether it's things like doggy vacay to, Airbnb or Lyft and Uber, you're seeing like tight vertical markets doing really well. I just saw one where it's a company that's doing dog walking, basically. It's like doggy vacay for dog walkers. So all these kind of very specific verticals are doing extraordinarily well. The tough part is going multi-geography, right? And you see that with a lot of the restaurant delivery services. You're going to have DoorDash here. The Peninsula, you'll have a completely different service. In San Francisco, another one in New York. So really having cross-geographical reach within the sharing economy has proven to be quite difficult.
So do you think Lyft and Uber, speaking on that, do they are they more tightly vertical, like you're saying, or do they compete with one another? Because I'm just wondering.
I think they do compete with one another on the lower end. So UberX and Lyft obviously do compete. But I would say that that's an example of why it's not a winner-take-all. Otherwise, you would have seen Uber completely dominating that market by this point.
But because I'm still I guess, like every other Facebook ad I get is like either a Lyft coupon or an Uber coupon, and sometimes I get both, right? So it seems highly, highly competitive, and it seems like they just want to steal market share from the other person. But you're saying that it's competitive because they need to reach some sort of scale, even in like San Francisco?
I think so. Yeah.
I see. That's interesting.
Because the scale determines also the supply, right? If you don't have demand scale, you can't have scale in supply. And supply also determines how well you activate your demand. And so it's a very kind of self-referential cycle.
That's interesting.
Yeah.
For more, please visit us at stanford.edu.